Welcome to the channel. In today's shifting economic landscape, where can investors find a reliable stream of income? For many, the answer lies in real estate, but not just any property. Today, we're focusing on a powerful and often overlooked engine of Singapore's economy, industrial real estate investment trusts, or REITs. These aren't just warehouses and factories. They are the backbone of e-commerce, the homes of cutting-edge life sciences, and the critical data centers powering our digital world. In a market focused on stability, the concept of durable cash flow is paramount. It means income that can weather economic storms. And in Singapore, a select group of industrial REITs have built their portfolios precisely for this purpose. So, how do you identify them? And what makes their income streams so resilient? Stick around as we break down 5 leading Singapore industrial REITs and analyze what makes them tick. Before we dive in, a quick and important reminder. This video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. So what exactly is the Singapore industrial real estate sector, and why is it so important? This isn't just about traditional factories anymore. The sector has evolved into a dynamic landscape of high-tech facilities. Think about the last thing you ordered online. It passed through a modern logistics warehouse, likely owned by a REIT. The data for your favorite streaming service? It's stored in a secure, high-tech data center, another key asset class. Singapore is also a major hub for life sciences and research, with specialized business parks and R&D facilities that require massive investment and in turn offer very long-term leases. This brings us to the core theme, durable cash flow. In 2025, we're seeing a fascinating split in the market. On one hand, there's a temporary oversupply of older, general warehouse space, which is putting some pressure on rents. But on the other hand, demand for these specialized, new economy assets like data centers, life science labs, and prime logistics hubs is booming. This demand is structural, driven by long-term trends like digitalization, AI, and e-commerce. For investors, this means the quality and specialization of a REIT's portfolio are more important than ever. A portfolio filled with modern, high-demand assets is simply better positioned to deliver consistent, reliable income year after year. To find REITs built for durability, we need to look beyond just the dividend yield. We used a strict set of institutional-grade criteria to screen for the 5 REITs we'll discuss today. First, operational certainty. We're looking for high portfolio occupancy rates, ideally above 95%, to ensure minimal income leakage. We also want a long weighted average lease expiration, or WALE. A WALE of over 3.5 years means there's multi-year visibility on rental income, which is a huge plus for stability. Second, financial fortitude. A strong balance sheet is non-negotiable. This includes a healthy interest coverage ratio, which measures a REIT's ability to handle its debt payments well above the regulatory minimum. We also look for conservative gearing, or leverage, keeping it comfortably below the 50% limit to allow for future growth. And critically, a high percentage of debt hedged at fixed rates provides a powerful shield against unexpected interest rate hikes. With those criteria in mind, let's profile 5 key players that represent different facets of this dynamic sector. First up is Capital Land Ascendas REIT, or CLAR. As Singapore's largest industrial REIT, its sheer scale and diversification are major strengths. CLAR has a global portfolio, but has been strategically increasing its focus on high-tech and specialized assets right here in Singapore. Management is actively converting older buildings into modern life science facilities and high-tech industrial spaces, a proactive strategy to ensure its assets remain in high demand. Next, we have Mapletree Industrial Trust, or MIT. MIT is a prime example of specializing in the most resilient sectors. A massive 54.8% of its portfolio is in data centers, complemented by high-tech buildings. This heavy exposure to the digital economy gives it a structural advantage. Financially, MIT is a fortress. It boasts a sector-leading interest coverage ratio of 3.9 times and has nearly 80% of its debt hedged, making its cash flows exceptionally resilient to interest rate volatility. Third is the pure play, Keppel DC REIT. If you want direct exposure to the explosive growth of AI and cloud computing, this is it. KDC owns only data centers. This focus translates into incredible operational strength. It has a portfolio WALE of 6.9 years, providing unparalleled long-term income visibility. And its pricing power is immense. In the first half of 2025, it achieved a staggering 51% positive rental reversion on renewed leases, highlighting just how critical its assets are. Our fourth REIT is Mapletree Logistics Trust. MLT is a logistics giant with a vast portfolio across Asia. It's a key beneficiary of e-commerce and regional trade. While the logistics market is facing some short-term supply headwinds, MLT's financial management is a case study in mitigating risk. It has one of the highest hedging ratios in the sector at 84%, which insulates its distributions from rising interest costs, despite having a tighter interest coverage ratio. Its shorter WALE of 2.7 years also means it can reprice its leases faster to capture upside when the market turns. Finally, we have ESR REIT. This trust is in the middle of a major portfolio transformation. Management is actively selling off smaller, older assets with short land leases and recycling that capital into modern, high-specification logistics properties aligned with the new economy. This strategy is designed to significantly enhance the long-term durability of its cash flow. For investors, it's a story of revitalization in progress. So how do these five stack up? We see a clear divergence in strategy and strength. Keppel DC REIT and Mapletree Industrial Trust stand out for their deep exposure to the data center boom. KDC offers pure play growth with maximum lease stability, while Mapletree Industrial Trust provides a powerful blend of data center exposure and an exceptionally strong, shock-absorbent balance sheet. CapitaLand Ascendus REIT offers durability through its immense scale and diversification, along with a proven management team that is actively future-proofing the portfolio. Mapletree Logistics Trust and ESR REIT are more exposed to the broader logistics cycle. MLT uses a high degree of financial hedging to ensure stability, while ESR is focused on a strategic overhaul of its asset base to build resilience from the ground up. For investors, it's a story of revitalization in progress. Of course, no investment is without risk. For all industrial REITs, the cost of debt remains a key factor to watch. While interest rates are expected to stabilize, any unexpected hikes would put pressure on distributions, especially for REITs with lower interest coverage ratios. The temporary oversupply in the general logistics and warehouse market is a near-term headwind for trusts like MLT and ESRs. If demand softens more than expected, it could impact rental growth. Finally, there's the risk of property obsolescence. Older industrial buildings that aren't upgraded can lose tenants to newer, more efficient facilities, which is why the portfolio rejuvenation strategies at CLAR and ES are so critical for long-term success. Looking ahead, the outlook for Singapore's industrial REIT sector is positive. The structural demand from the digital economy, life sciences, and advanced manufacturing is not going away. For high-specification assets, this ensures a long runway for rental growth. At the same time, a stabilizing interest rate environment is expected to reduce financing costs, providing a welcome tailwind for all REITs, starting in 2026. With many REITs currently trading below their net asset value, the coming years could offer a compelling combination of sustainable dividend income and potential capital appreciation. The key takeaway is this: durability is not accidental. It is engineered through strategic asset selection, prudent financial management, and a forward-looking approach to portfolio renewal. The REITs that excel in these areas, particularly those aligned with the new economy, are best positioned to deliver resilient, long-term cash flow for investors.
And that's our look at 5 Singapore industrial REITs built for durable cash flow. We hope this breakdown has been insightful. If you found this video helpful, please give it a like and subscribe to the channel for more in-depth financial analysis. Thanks for watching, and we'll see you in the next video.